If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Bangladesh's economy in the second quarter across 2024-2025 presented a picture of stability, with steady growth, disinflation from mid-year peaks, and a policy mix calibrated to safeguard the taka and anchor expectations. According to Trading Economics' current readings, the GDP annual growth rate for the fiscal year ending June 2024 registered about 5.82%, slightly above the prior year's 5.78%, underscoring durable domestic demand and continued strength in garments, construction, and services. Despite tighter financial conditions, momentum into 2025 remained broadly intact, with models pointing to growth near the mid-fives, and quarterly dynamics consistent with a stable Q2 backdrop, helped by easing import pressures and gradually improving electricity supply to industry. On the labor side, the unemployment rate stood around 4.7% as of December 2024. On the Trading Economics country list, indicating a relatively tight job market by regional standards. While updates through mid-2025 remain limited, the combination of moderated inflation and steady export orders helped keep labor conditions broadly stable into Q2. Monetary policy remained the key anchor. The benchmark interest rate was last recorded at 10% in July 2025. On trading economics, a level that reflects the central bank's corridor framework, and a deliberate shift from emergency tightening toward cautious normalization. Even at 10%, borrowing costs stayed elevated enough to restrain credit-driven demand. Yet the policy stance turned more predictable for banks and firms, reinforcing the narrative of stability during the quarter. The inflation rate, which had been a central concern through 2023, showed meaningful improvement during 2025. Annual inflation eased to 8.48% in June 2025, its lowest since mid-2022, before ticking up to 8.55% in July as food and transport components firmed. Importantly, the underlying trajectory still pointed to gradual disinflation, versus earlier double-digit rates aided by tighter money, improved farm supply chains into the monsoon, and more stable energy pass-through. Monthly CPI dynamics were noisy, with July registering a sharp sequential rise, but forward indicators suggested inflation would drift lower on average through the second half, preserving household purchasing power relative to the prior year and helping validate the stable Q2 view. On the fiscal side, debt sustainability remained manageable by emerging market benchmarks. Trading Economics shows Bangladesh's government debt to GDP around the low 30s, with the latest posted baseline at 31.7% and model projections near 32.6% by end 2025. Although the exact 2024 year-end print was pending in the database, the signal remained clear. Public debt ratios were contained compared with regional peers, providing room for targeted capital spending and social outlays, without jeopardizing macro stability. External debt ticked higher in 2024 in dollar terms, but the overall sovereign debt burden stayed moderate. Within this setting, Q2 outcomes looked balanced. Real activity benefited from receding input cost pressures and a firmer electricity availability profile, while high but stabilizing interest rates disciplined speculative demand and import appetites. The current account remained close to balance on Trading Economics forecasts, with remittances cushioning any softness in apparel shipments, and food imports normalizing after earlier price spikes. Banking system liquidity adapted to the corridor and reference rate regime, keeping the interbank rate near the policy setting. Trading Economics showed the one-month interbank near 10% in mid-2025, thereby enhancing transmission and improving predictability for treasury managers. Business surveys pointed to steady orders in knitwear and woven exports, alongside gradual recovery in domestic construction demand as input prices steadied. Private consumption was supported by resilient rural incomes and a turn in real wage growth as inflation cooled from prior highs. The combination of these elements framed Q2 as a period of stability rather than acceleration. Crucially, risks looked more balanced than a year earlier. Inflation upside risks from food and administered prices persisted. Yet the overall inflation trend moderated enough to allow the central bank to hold or fine-tune the policy rate around 10% without reigniting price pressures. On growth, baseline projections in Trading Economics implied mid-single-digit expansion consistent with potential, neither overheating nor stalling. On jobs, the 4.7% unemployment reading at end 2024 provided a sturdy starting point, and there was no evidence in available mid-2025 indicators of a material deterioration. On debt, trading economics trajectory toward roughly one-third of GDP suggested space for counter-cyclical support if required, while adherence to fiscal anchors helped keep sovereign spreads contained. Bringing the indicators together for clarity, GDP annual growth rate hovered around 5.8% in FY 2024 and appeared to remain near that zone into 2025. The unemployment rate was about 4.7% at the latest posted 2024 reading. The interest rate stood at 10% in July 2025. The inflation rate ran at 8.48% in June and 8.55% in July 2025. And the debt-to-GDP ratio was around 31.7%, with models pointing near 32.6% by end 2025. Each piece aligned with a stable Q2 narrative: growth steady, prices easing from highs, policy credibly restrictive but less volatile, and fiscal metrics well within prudent ranges, while export demand and weather-related food dynamics require watching. The Q2 snapshot for Bangladesh was best characterized as stable progress. The economy held its course through a challenging global backdrop, maintaining mid-single-digit growth, guarding against inflation persistence with a 10% policy rate, preserving labor market gains, and keeping the public debt burden in check relative to output. Looking ahead to the remainder of 2025, trading economics projections envisage GDP growth near recent trends, disinflation if commodity prices cooperate, and a steady policy rate path unless shocks arise. Under these assumptions, Q2 stability should extend into the second half, reinforcing confidence for households, firms, and investors. The economic fundamentals demonstrate Bangladesh's resilience in navigating global uncertainty while maintaining domestic stability. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.